All right, today we're going to break down one of the most powerful signals you can find on a chart, the outside bar. We'll get into what it is, why its location is absolutely everything, and how you can actually use this simple two-candle pattern to spot major shifts in the market. Just think about that for a second. With all the chaos and noise in the market, what if the biggest clue to a huge reversal or a massive breakout was hiding in plain sight, in just two candles? Well, that's exactly the kind of power we're talking about today. So here's our game plan. We'll kick things off with the signal itself. Then we'll cover the golden rule of context. After that, it's all about strategy. We'll dive into 3 core ways to trade this, how to actually execute the trade, and finally, the psychology that holds it all together. Okay, let's get right into it. Before you can even think about trading this pattern, you first have to really get what it is, and maybe more importantly, what it's telling you about the fight between buyers and sellers. So what is an outside bar really? It's a two-candle pattern where the second candle's range, its high and its low, completely swallows up the range of the candle before it. But listen, this is more than just a pattern. It's the story of a violent battle. In one single candle, the market swept below the prior low and then roared all the way above the prior high. By the time that candle closes, one side has won a huge victory, and a whole bunch of traders just got trapped on the wrong side of the move. And this brings us to the 2 flavors of the pattern, bullish and bearish. A bullish outside bar? That shows up after prices have been falling. It first makes a new low, which sucks in sellers who think the downtrend is going to keep going. But then, bam, it violently reverses and explodes higher, trapping all those sellers and signaling that all that selling pressure just got soaked up. On the flip side, you've got the bearish outside bar. This one appears after an uptrend. It pokes just above the previous high, luring in all those eager breakout buyers, and then it just collapses. It traps them in losing positions and screams that the buying momentum is totally gassed. Now, let's talk about what is, without a doubt, the most important rule for trading any pattern, not just this one. Getting this right is what separates the pros from the amateurs. And it's simple. When it comes to the outside bar, location is everything. You know, it's wild how many traders get this wrong. This quote says it perfectly. Trading candlesticks in isolation is a huge mistake. An outside bar that pops up in the middle of a messy, choppy chart, it's just noise. It's meaningless. Its power is only unlocked when it appears at a really significant spot on your chart. So where are these high probability locations? Well, number 1, at key support or resistance zones, places where a fight is expected. Number 2, at the very end of a long, tired-looking trend. Third, during a healthy pullback inside an already existing trend. And finally, during a tight buildup right before a major breakout. These are the zones where an outside bar isn't just noise, it's a massive flare telling you to pay attention. Okay, now that we know what to look for and, crucially, where to look for it, let's get into how we actually use this. Here are the 3 main strategies traders use to trade the outside bar. First up, we've got the classic reversal play. This strategy is all about trying to catch the potential end of a trend, right as the market is running on fumes. So here's how a reversal usually looks. You'll see a strong trend that starts to lose its steam. The candles get smaller, things start to look indecisive. Then you get a huge engulfing outside bar in the opposite direction. That's your signal. It's a sudden, powerful shift in control that often marks the true beginning of a brand new trend. Now, the second strategy is the total opposite. Instead of trying to fight the trend, you're using the outside bar as a green light to join it after a little break. This is often a much higher probability setup because you're trading with the big money, with the dominant trend. So the market's clearly moving up, but it takes a natural breather, it pulls back a bit. Just as some traders start to get nervous, a strong bullish outside bar forms. That's your cue. It's a sign that the original buyers are stepping back in and the next leg up is probably just getting started. And now for strategy number 3, which is a big favorite for a lot of price action traders. Using an outside bar to basically light the fuse for a breakout from a tight range. This is such a powerful setup. Just picture the price coiling up like a spring, getting tighter and tighter against a key resistance level. You can see the pressure building with all these small candles. And then a massive outside bar just smashes right through that level. That's the spring releasing, and it often leads to an explosive new trend. So we have our strategies, but just knowing a setup isn't going to cut it, right? We need a clear plan for how to execute and even more importantly, how to manage our risk. Let's turn all this theory into real-world action. Here it is, a simple 4-step plan. Step 1, confirm the context. Is this happening at a key level we already marked? Yes? Good. Step 2, spot the pattern itself. Does the candle's range fully engulf the one before it? Check. Step 3, and listen up because this is non-negotiable. You wait for the candle to close. A pattern is not a real signal until that candle is finished. Do not jump the gun. And finally, step 4, plan your entire trade. Know your exact entry, your stop loss, and your profit target before you even think about clicking a button. Okay, let's talk about the thing that actually keeps you in this business. Risk management. Your stop loss has a logical home, and it's right beyond the high or low of that outside bar. Why there? Well, because if the price moves past that point, the whole reason for your trade is now invalid. It's a structural stop, not some random guess. This also means you have to adjust your position size. A wider bar means a wider stop, which means your position size has to be smaller to keep your risk the same. And please, avoid these patterns in choppy sideways markets. That's just asking to get chopped to pieces by false signals. All right, let's get into the most important part of all of this. What's going on between your ears? You can have the most perfect technical setup in the world, but if your mindset isn't right, it's all for nothing. Trading this pattern really boils down to 3 things. First is patience. You have to have the patience to wait for that A+ setup in the right context, not chase every little signal you see. Second, discipline. You must honor your stop loss, no exceptions. And third, confidence. When that high probability setup finally does appear, you have to have the confidence to pull the trigger without second-guessing yourself. Okay, let's wrap this up and put all the pieces together. So here's the bottom line. The outside bar is an incredibly powerful tool for reading what's happening in the market. It can signal a huge shift in supply and demand. But it is not a magic bullet. It's just one piece of a bigger puzzle. Its power is amplified when it lines up with the bigger market context. So think of it as a really strong signal, but not a complete trading system all by itself. And that leaves me with a final question for you. When you're looking at something volatile like Bitcoin or gold, which of these setups do you trust more? The powerful trend reversal, the trend continuation on a pullback, or that explosive breakout? Let me know what you think down in the comments. Thanks for watching.